Hello students, welcome to day 4 of our mathematical interest theory course. In today's discussion we will continue our previous topic, the growth of money. The growth of money. In yesterday's lecture we discussed that how we can calculate the simple interest and the compound interest and what are the differences between simple interest and compound interest. In today's lecture, we will discuss what a discount rate is according to Buffett, what to look for in discount rates, what is the future value of a company and cash flows, Buffett's strategy in using treasury rates, what is a good discount rate, and why you should use margin of safety. So first of all, we will look at the simple explanation of the investment discount rates. The investment discount rates can be very confusing to understand at first because they are very similar to the interest rate. For any budding investors who is trying to understand future value, and then discounting to get a present value can be quite tricky. So we will try to provide a very simple explanation. I will give you a brief explanation of the of the interest rate and the discount rate. They are same, but we call them interest rate whenever we are supposed to calculate the future value of any amount. When we are supposed to calculate the future value of any amount, this rate is called interest rate. And when we are calculating the present value of any future amount, this rate is called discount rate. So for your understanding, this could be the possible explanation. This could be the possible difference between simple interest and the compound interest. Now moving further, how we can calculate the future value of a company? We can calculate the future value of a company by predicting its future cash generations and then adding the total sum of cash generated throughout the life of the business. This requires you to calculate a growth rate and then apply it to company's free cash flows. For example, let's assume a company's latest fiscal filing revealed $100 in free cash in 2008. With a growth rate of 10%, the company will be able to generate $110 in free cash in 2009 and $121 in 2010, and so on for the next 10 years. The total sum of the free cash flows over 10 years comes out to $1,753. This is the sum of cash flows that we can generate over 10 years. Now the time value of money tells us that this sum of $1,753 over 10 years is not worth $1,753 today. Why? Because this is the accumulated amount that we can get in 10 years in future. But today this total amount worth less. We could not want to invest 1753 today in one lump sum such that we will receive 1753 over 10 years. If we are generating the same amount, suppose if I ask you to give me $5,000 today, and I will give you back $5,000 after 10 years, will you be willing? Is it suitable for you? No, it is not suitable for you. It is not suitable for any rational person, because after 10 years the worth of this $5,000 will be lesser. If you are willing, it means you are not getting any interest on any return on your investment. So here is an example. When people pool their money together for a real estate investment, they may $100,000 today to get a price of 1 million. In a resort. In this example, they are assuming 1 million is worth 100,000 today. Their money will grow by by 10 times in the future. Therefore, it is important to figure out how much you are willing to pay today in order to receive 1753 over the next 10 years. This is called the growth of money. Why? Because the value of money is growing every year. Will grow every year. There are multiple reasons behind that. In the coming lecture, we will discuss the reasons behind the growth of money. So there is no hard and fast rule for choosing a discount rate. We will keep it very simple. If you choose to use a high discount rate such as 12% or 15% to the future to discount the future cash, it just means you are willing to pay less today for future cash flows. But an important point to understand here, it is very important, if you are choosing a very high discount rate, then it means that you will pay very less amount today, and if you decrease your discount rate, you will pay more today. So the present value and the discount rate has a negative relationship with each other. By increasing the discount rate, you will pay less, and by decreasing the discount rate, you will pay more today. So remember, you should be very confident while selecting the discount rate. You should think very positively. You should think rationally while choosing the discount rate of your investment. Now, the Buffett actually tells us that using a rate that was equal to a risk-free rate return, which was very high, should the money in 10 years treasury bond, he would never earn around 8.85% at the end of without taxes. We have to pay taxes as well. So if you use the risk-free rate, treasury rate as your discount rate, measuring the stick, you would only be able to discount the future value around 1 to 3% at most. But you have to account for other risk factors as well, such like the exchange rate fluctuations, such that interest rate fluctuations, such that inflation rate fluctuations, such that taxation policies. There are so many reasons behind the increase in discount rate. So here the question arises that do you want an annual return of 3% from your portfolio? Obviously not. No rational person will be willing to earn only a 3% from his investment, because it is not suitable for him. So Buffett's choice to discount by treasury rates was his minimum required return. So actually he basically gives we can say that a standardized way or standardized basis to calculate the discount rate. He also used the treasury rate as a measuring stick to all businesses rather than assuming the different rate of different businesses. He actually standardized the discount rates, that this is the minimum rate, and beyond that rate you can charge any amount. So in order to calculate the intrinsic value means original value. You take those cash flows that you expect to be generated and you discount them back to their present value. So in our case, at the longer time treasury rate and the discount rate doesn't pay you as high rate as it needs to be, but you can use the resulting present value figure that you get by discounting your cash flow backs at the longer time and the treasury rate as a common yardstick, just to have a standard of measure across all kinds of businesses. So we will say, what is a good discount rate? A good discount rate is basically it ranges between 9 to 12%. So this is, we can say that this is a guess that a good discount rate should not be more than 12%, or it should not be lesser than 9%. Just like Buffett, he mentioned a minimum rate of return, that it could be happen between 9 to 12% depending upon the type of company, depending on the type of company. If the company is very stable company and the company is generating profits, then we can use a 12% interest rate. And if the company is a newly organized company, newly established company, and the company's profits are not too high, then we can use a 9% interest rate. So we can see 20% or even 30%, but that will just make our research so much harder and limited, because we will be trying to buy $17.5 billion for only $13.4 billion. The difference is too high. Difference is too high, which is 5 billion. Rationally speaking, it might not be possible to generate this much of amount within given time period. So if we thought that we are getting a stream of cash over the 30 years that we felt extremely certain about, we would use a discount rate that would be somewhat less than if it were one where we expected surprises, or where we thought there were a greater possibility of surprises. So in that particular case, we can use 9% rate or but not 15% rate. However, the important aspect is not deciding upon a discount rate, but in being logical and reasonable about the cash projections. So we will not use different discount rate for different businesses. Normally we use a standardized discount rate for all kind of businesses. So we will not forget the margin of safety. What is the margin of safety? Margin of safety is basically calculated when no one can accurately predict the future. Note that a high discount rate may warrant a lower margin of safety, but that is up to the investors. Personally speaking, we can use 12 to 15% discount rate with a 50% margin of safety. With a 50% margin of safety. So for majority of many investments, we can use minimum of 15% annual return to buy $1 for 50 cents. So finally speaking, we don't justify the purchase of a company just because it fits the numbers. We should not fool ourselves in believing that a cheap company will yield good return. No, it's not like that. A bad company is bad investment no matter what prices it is. Look closely at the investment discount rates and figure it out for yourself. A piece of turd in a bowl to resin is still a piece of turd. It will not become resins. That's all about our today's discussion. I hope you have enjoyed the lecture, and if you have any question you can ask me. Thank you so much. See you in the next class. Bye bye.